All right, let's get into Jedi options here last. Every Wednesday, Tyler Craig joins us here on the halftime report at Dead Tackle Trading. He is an educator, he's a trader, he's a coach, he is a mentor, system designer, and he's done a lot in the options market with the equity market, obviously, in tow. And I love the way that you teach, Tyler. And so we kind of crafted a segment for you to highlight the strengths of what you have, and that is options knowledge. And that's our Jedi options segment. Tyler gets to take some strategies, some concepts, some technique, whatever it might be on that's on his radar that week, and just kind of dive right into it and really give a good bit of education in the options market. Tyler, what you got planned for us today?
Yeah, today's going to be fun. A little bit of a unique discussion that I think is going to make you think and gives you maybe a taste of the types of things we do in the Team Phoenix Trading Lab. So this is a strategy that we use as one of our bread and butter trades when the conditions are ripe. The motivation, this is a slightly bearish trade. The motivation for this is twofold. Number one, it's to respect the seasonality, September, maybe, we get a little bit of weakness coming in. Suppose that's a concern for you, but it's not so great a concern that you want to straight up go out and buy puts, right? You want to reduce exposure in the portfolio, but you want to do it lightly, carefully, and you want to do it with a strategy where even if the market doesn't go down, you still might be able to turn a profit. So my intent with this particular trade, I put this on in a specific situation where the market is overbought and volatility is low. So one of the reasons why I like this strategy, and I'm going to draw a little picture, is because this is usually a situation where you don't really do a trade. And so I've created a pattern and a setup that becomes a trading opportunity that otherwise I wouldn't have done in the past. And I like finding new trading opportunities because the more you trade, if you have good systems, the more money you make. So visually, this would be what the stock looks like. Okay, so stock price is extended. And at the same time, implied volatility, which is the price of options, is going to be low. And usually that's the case, right? Like usually when the market's up a lot, there's not a lot of fear and volatility is low. Well, what would you normally do in this situation? Normally, looking at the stock price here, you wouldn't buy it because it's overbought, and you wouldn't short it because it's in an uptrend. Normally, you would wait for a pullback and then do something, right? Or maybe it pauses, it goes sideways, then you trade a breakout. So again, this is a situation where usually I would just wait for another setup. Well, I'm going to show you a trade where you want to enter it right around here, right? And if you think about what your directional bias is, I think this stock is either going to go up a little bit more and then finally pull back because it's so extended already. But that if it pulls back immediately, it's not going to completely crash because it's in such a good uptrend. And so I think the dip gets bought. And so essentially, I think within the next couple of weeks, the price could be at a similar level, if not lower. And I want to build a trade around that, right? So this trade's going to be slightly bearish. So it's going to be negative delta. Okay. At the same time, it's a positive theta trade. So we're going to make some money due to time decay, which is the opposite of what buying a put option would be. So if I were to just straight buy portfolio protection, buying puts, time decay is going to be hurting me. Here, I'm going to get a little bit of a hedge, but time decay is going to help. So that's one thing I really like about the trade. The third dynamic is if the market does sell off, you're probably going to get an uptick in volatility. And so I want to position myself to benefit from that. Now, to be fair, if you just bought a put option, you would benefit from the rise in IV. Okay. But again, I'm not that bearish. Partly from a fundamental perspective, I feel like we're still in an environment where if the market did sell off, traders are going to be looking at the fourth quarter. And they're going to be looking at this wall of money and low interest rates behind the market. Just the fundamental and monetary situation right now is supportive of higher stock prices. I think that puts a little bit of a bottom in terms of how low the market goes if it sells off. So that, again, argues against just straight up buying puts. Could be wrong. But this trade also will make money if volatility increases. Okay, so the characteristics that drive this trade: slightly delta negative, positive theta, positive vega. And importantly, I can still turn a profit if the market goes up a little bit from here. And so I'm doing a higher probability trade, higher probability of profit than buying a put option. But I am getting a little bit lower reward. And if the market implodes, I'm getting a much lower reward. But I'm willing to do that in light of I'm really not that bearish on the market. Okay. So in terms of the philosophy behind the trade, that's kind of what we're thinking. Now I'm going to show you how to build it. Before I do that, Tim, any questions?
Not at all. In fact, I really like this because it's got a negative delta, positive theta, slide to it. And so really, I mean, if you're looking to add negative delta in your portfolio and you're an option trader, there's not that many ways that you can do it that also give you positive theta. So I like this. I like where you're going with this, especially on the backdrop of where the market conditions are. So yeah, just build it out. Let's see what you got.
The other premise that I want to make clear is my portfolio right now is bullish, right? And that should always be the case when I'm putting this trade on. So I'm not turning things bearish. I'm just getting less bullish, right? I feel like this is an easy trade to add because I should have just made some good money, right? Like look at the Nasdaq, right? If this is the proxy for the market, we just went up a bunch. I got a bunch of bullish trades, okay? I'm fine if the market keeps going up. My concern is what if we pull back? Right? What kind of trade can I add that makes me less exposed to a pullback? It's easier to add trades that reduce your overall exposure than to add trades that increase your exposure. So putting some of these on when the market's extended and I made a bunch of money and I want to reduce risk a little bit, it's a very easy decision to make, much easier than going and buying far out of the money puts and hoping the market implodes, right? So the trade structure, this is a put calendar spread. Okay, it's a horizontal spread. It's a little more, I think, advanced than some of the stuff we've talked about. But the structure here is you're going to buy like a 2-month put and then sell a 1-month put against it. So I'm going to buy a 2-month put and sell a 1-month put against it. What makes it a horizontal spread is you use the exact same strike price. So with the Nasdaq here at 382, I'm going to use a put option that's slightly below the market because I'm planning on a pullback, or said another way, I want to make money if the market pulls back because that's the concern. My other trades will make money if the market goes up. I want something that makes money if the market goes down. And when you set up a calendar spread, your profit peaks at the strike price. So if you pick the 380 strike price, that's where you want the stock to go. Well, that's not very bearish. I got to pick something below the market. So that's where I come into the profit if the market pulls back. I kind of like this 375 number. So essentially what I'm going to do is buy a 2-month 375 put and sell a 1-month 375 put. And I've got this calendar spread sitting just below the market. And if we pull back into that zone, that's what's going to give me the profit. Okay. This is tough if it's your very first time. You really got to look at the risk graph to visualize what's going on here. But conceptually, I think you can see on the chart, hey, if this kind of pulls back towards this zone, that's really where the trade's going to pay out. But importantly, if it doesn't pull back to 375 and just kind of hangs out up here, we're still going to profit. The concern is going to be if this thing rips to 390, 395, we're going to have to make a few adjustments. Okay. So to build out the trade, I'm going to go to the trade tab. We're in a tricky spot because there's really only, this is saying weekly, but it's not. This is actually, which one is the, what is it? The 17th? Okay. So the 17th, this is the monthly for September, but there's only 16 days. Mm-hmm. It's a little easier if I buy 60 days and sell 30 days. Buying 44 and selling 16, your window's too small. So what I'm going to have to do here, Tim, is I'm going to buy a November option and I'm going to probably sell a weekly at 30 days against it. So you don't want to go too far out of the money because then you really have to have the market just get decimated to get there. Usually the delta is going to be between about 35 and 40. So you could set it up at 35. You'd be at the 371 strike. The 40 delta makes it just a little bit less bearish. So I don't have a strong opinion between these two. I'm actually going to
go back to the chart for a second. I think part of the way that I personally would make a decision, you tell me how you think through this, because delta guidelines are fantastic, very important. And depending on the strategy, they're more important than other strategies. Like when I'm dealing with calendar and diagonalized spreads, I think you can kind of tweak them, especially on products like the Qs and the SPY, where there's so many strike prices. So there's some fiddling to do in an options trade, right? I mean, that's the beauty of it. Also the complexity of it. Some people love that part of it. Some people don't like that part of it. I love that part of it, that you can add the complexity. I'm looking at the chart here, and there's no way, because that profit zone is going to be where you anchor that strike. 375 kind of lets it come back down just into a reversion to the mean. Even you just have a pullback and it's still in play. When you start building a profit zone as low as 370, you're expecting a deeper pullback, right? Which would be fine, but that goes to bias and expectation as well. I would probably, because if the intent, and if I'm following this right, Tyler, you correct me if I'm wrong, the intent is to add bearish delta into a bullish portfolio, just to kind of take your foot off the gas a little bit. Okay. I would do 375. That way I can move into the profit zone on the risk graph, even with just a slight pullback personally.
Okay. And I would agree. So in this case, you would lean towards, let's do the 40 delta in light of the chart and that kind of being my lower target. Perfect. So I'm going to buy the no 40, 40 delta, 375 strike. And again, it's saying it's the weekly. It's not. This is the monthly. And then again, normally I would sell the front month, but because it's 44 days out, I'm going to go ahead and use the weekly. It's got 30 days. The liquidity is still pretty good on these. And you're just going to sell the same strike that you purchased. So I bought the 375. I'm going to sell the 375, right? You know, one other mistake I made, Tim, that I shouldn't have, because I know better. The delta is on the short option, not the long option. So delta around 35 is on the short leg, not the long leg.
That's how you teach it through your rule. Okay, gotcha.
Yeah, so actually we're around a 33 delta, which tells you wouldn't want to go much further down because you don't want it to be a low probability bet. You want a higher probability bet. So that's bearish enough at 375 is the point.
Gotcha.
Yeah. In fact, if anything, you might go a touch closer if you wanted to.
Like 377, something like that.
Yeah.
I don't know. I like that 375. I think
so. We'll stick with it. So one thing here is it's not an expensive trade. And so you can't do these on super cheap stocks. You actually need the stock to be like $150 or higher because these are really cheap trades. And I'm not going for a big profit. We're only shooting for about a 15 to 20% profit. And if I build this out, it only costs me 75 cents. 15% on that's like $10. It's nothing. So I really need this trade to cost me 200, 300, 400 bucks to make it where a 15 to 20% return moves the needle. And that essentially means it's got to be a higher price stock, right? The other reason I really like doing these on ETFs is because I know if the market sells off, this trade will make money. Sometimes you pick some random stock. You're like, hey, I need to add some bearish exposure. Let me pick stock ABC. The market pulls back and your stock doesn't. It's like, that's the last thing I want. I want to ensure that the product I pick makes money if the broad market pulls back. And the surefire way to do that is just use a market ETF, right? Because then the correlation is 1 for 1. So let's take a look at the risk graph. And let's set the slice to the current price. All right. This is what the trade looks like. Usually your stock price is towards the right edge of your profit range, which is fine because we wanted to have room to come into the profit towards where you centered your put calendar at. So assume that you just did one of these. Your profit range is between about 386 and 364. So if you just look at the chart and you say, hey, do you think this thing could be between about 386 and what did I say, 364?
364 was the low end of that break.
364. So first of all, that seems like a neutral to slightly bearish bet.
Well, think about it. The most profit is in the exact middle of those two lines. Okay. If it goes higher, you will lose money on this trade.
Yes.
But if it goes higher, the premise here is that you're a bullish investor and trader. You've got a lot of bullish stuff going on anyway. So the loss here would be acceptable to that portfolio because they're profiting on other transactions, correct?
Correct.
Mm-hmm.
And if ideally what'll happen here, Tim, is I'll stay in this trade until we get a pullback. I'll take the profits on this and then we bounce. Like if you manage it right, you make money on both sides, right? If at some point the Nasdaq pulls back into the range, you hit your 15 to 20% target, you peel off the calendar. And then if the uptrend continues, at some point you're making money on your bull trades as well, right? So I will often have months where I win on both because of the timing, right? So first of all, if I just did one of these and left it, you advance the clock a week or two. You get a pullback into 375. You get a little bump in volatility. I increase the volatility and this thing shifts up and boom. I mean, I put in 585, 15% profits around 90 bucks ish, right? 20%, 100, 120 or so. You're at your target. So you get a week or two to go by, you get a pullback anywhere in the vicinity of 375, little bump in vol, you're done.
It's really interesting, and I'm glad that you decided to go through this way here today. There's a couple things. Number one, I personally don't think I would even take the trade right now. I'm not as concerned about the pullback as maybe others are, but I understand the logic behind it. Having the ability to add a hedge to an account is an incredibly valuable skill set, okay? There are times to do it. There are times you're going to want to use it. There are times that it's the most common sense thing to do. And I think there's logic behind this one here for sure. Absolutely, Tyler, especially when it's not just a direct go out and buy insurance hedge. Sometimes you got to do that. That's the brake pedal, right? This is not a brake pedal situation. This is where you're just pulling your foot off the gas slightly so that you're having more natural balance in the overall portfolio. It's an interesting concept, interesting idea, especially within the ETFs against a market. And, it's kind of cool to see you go through it. Matt, let's get you back in here and kind of just give us your thoughts on the put spread using put options on the Qs in general as a hedge with theta positive and negative delta, transaction here. What do you think?
Honestly, great way to hedge your bullish position without. I think a wonderful point was made where the index versus an individual stock, right? So many times we'll go put on one individual trade on one individual component of the market, and it will do something completely different from the marketplace itself. And so if you're trying to hedge a little bit of market volatility, using a market instrument that tracks the market, very smart, very smart. So that's number one. Number two, Jedi options is just, I said it last week, said it the week before, man, it's my favorite. It's my favorite segment we do on the halftime report. I love the depth you two go into, and Tyler, you do a fantastic job. Just thank you for our entire community.